Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, March 28th, 2024. S&P 500 currently sitting at 52.52. I'm David Zarling. I'm here with the official toddler bedtime expert, Ian McMillan. Episode 200.
200.
That's incredible.
Crazy. Yeah, 200 episodes. I forget when we started. Sometime late 2018.
Yeah, I think it was late
2019.
Yeah, late 2019, because we had a little bit of an uptrend before the COVID crash. Our listeners got to be with us through a COVID crash, a bear market in late 21, early 22. There's been a lot of things that have happened in the market since then, but what I appreciate, Ian, is you've been consistent with me on this, and I know our clients appreciate it. They give us comments back about appreciating the information that we put out. And here we are on Monday, Thursday, 2024, episode 200. Great round number. We're not done, but I think it's worth celebrating. I think it's worth acknowledging. Doing 200 of anything.
I think stocks are up since we started the podcast.
True story.
And we went right into COVID and probably episode 12. I don't know what that would have been. Probably episode 20.
Yeah.
And here we are, episode 200. Followed the trend of the markets for 4.5 years.
The average return of the average stock on this episode is finally breaking out using something like the value line geometric index. So, right, you mentioned S&P.
The average
500.
stock has been flat this whole time.
Basically, like if you look at, we're a little bit higher than the COVID highs from January of 2020 for the average stock. Average return for the average stock is just slightly positive since January, about 4% positive, 5% positive since January of 2020. But you're right, when we look at more followed indexes, such as the S&P 500 higher, and that's good. Like these are things that we want to see. I think big week for small caps this week.
They're trying, man. God bless their souls. They truly, I will say, if this all falls apart at some point in the coming weeks, months, or whatever, it won't be for a lack of effort from Russell. So I give them props.
We've slammed on Russell in the past, and rightfully so. We're also, I
will give him credit when credit is due.
Yeah, and right now, the Russell 2000 is on the verge of recording a price level almost there, above March 2022.
Yeah.
And so if you think about that, we're in 2024, March of 2024. So 2 years of 0% return for small caps.
And it's like literally exactly I think it is March 29th, and market open tomorrow. So it'll be a year.
So 2 years.
It's that neckline at 211, 210. Remember us always talking about 210 forever and ever and ever and ever.
Well, that goes back to late January of 2021. So
that was that whole, right? February 2021 is when the average stock kind of fell apart.
So those Russell 2000 has a 0% return since January of 2021. So 3 years and 2 months. It sounds like a bubble, right?
That's crazy. And I'll never forget, that breakout, and I'm sure we were so bullish in November 2021.
Sure. Yeah, you broke out, and the failure was the beginning of the correction.
Yeah.
Right? The end of 2021, breadth narrowing, failure of small caps, the range failure that had been built from January of 21 through January of 2022, that broke down. We've been nothing but in a 20% range in small caps since that point. We're now on the verge of clearing that. And we do not get to say that small caps have a 0% return for 3 years that we're in a bubble.
Yep, hard to make that argument. Now, other indices, cap-weighted indices, certainly tilted towards different sectors pretty heavily, have done differently, and it's totally fine. It's the way the game is played. But yeah, hard for me to believe that we're in some type of raging bubble if, you got 200, what are kind of considered your more small caps, more quote unquote risk on.
I think it's a combination, right? Because you
I
have
don't, yeah, maybe that's not the best argument, but it's hard for me to.
well, small caps, when you look at them from a weighting perspective, right? You do have risk on like your biotechnology, which is the second largest industry at almost 8% of small caps are biotech. Third
Yeah.
largest is software. And then you've got some economically sensitive areas like oil, gas, and energy at 4.5, and banks. So the 25% of small caps are either economically cyclically sensitive or risk on type. So I think it's fair to say, yes, they are risk on. It also has a value tilt towards it, right? Because the largest industry is banks.
Does have a value tilt. Yeah, like I'm such a big growth versus value person. I think that's a great place to start your top-down analysis. And, across pretty much so if I take large cap growth versus large cap value or small cap growth, small cap value, right? I mean, growth versus value pretty flat for 2 months, kind of breaking down here. I will say mid cap growth has been the one that definitely has not given it up until like the last couple days. Growth versus value, and for the mid cap names, just never really stopped. That was very powerful towards growth, but you are starting to see, now specifically when we're talking about growth versus value, maybe some cracks, and value turns the corner. And to your point, that bodes well for your small caps, I think.
Yeah, and I think that's a great point because mid cap value using something like MDYV is now clearing new highs for the first time, like right now.
Yeah.
And that's a quality characteristic, right? We know that new all-time highs tend to cluster. We've seen that with S&P 500. We've seen that with the NASDAQ. Are we just getting started in this mid-cap space? Mid-caps and small caps definitely showing some positive characteristics the last 2 weeks. But this goes back to what was highlighted in previous episodes, pre-200 episodes, where we highlighted where the breadth thrusts, where we've seen demand since the breadth thrust had happened in December. And we've continued to see that level hold for things like small caps. It's required patience. It's not like small caps have gone in a straight line since then.
Yeah.
But definitely quality information. I mean, this would be the highest weekly close for small caps since the end of January 2022.
Very true. I won't say excited, but it would be nice to have a change of scenery other than Magnificent Seven and, whatever. Like, I'm down to buy whatever if its relative chart is moving higher for my benchmark.
Yeah.
So I think part of me is definitely ready for some small mid cap environment. So I say that, big picture, we take something versus NASDAQ versus NASDAQ 100 versus Russell. So, a pretty good solid growth you got your large cap growth and like your small cap value.
Yep.
They're kind of opposites at extremes in my mind. Big picture, there was a breakout to 24-year highs in this relationship last year in June when I look at QQQ versus IWM.
Yep.
And we are still above a rising 200-day. So as much as I would love I'm with everyone else, I want it to happen, but just want to be clear that still got some work to do, but it would be great because, if we do break down, there's a lot of potential there in the coming, I think throughout the entire year. but hopefully at least throughout summer.
Well, now I'll see your QQQIWM and raise you to QQQIWN as in Nancy, your small cap value. And it's really interesting.
Yeah, I see your failed breakout.
And a momentum divergence. It will be interesting to see what this summer brings, right? We're entering summer. The days keep getting longer.
And IWM probably a better canary in the coal mine, right? I mean, if you would see value move first, the strength from value. So that makes a lot of sense to me. So hopefully we can manifest some broad outperformance. We've talked about it on here a lot. We've talked about it in client letters. Your mega capture, I mean, Apple, Microsoft's been pretty well, but Apple just
negative on the year. Negative on the year.
That's crazy, right? And how many people have spent the last 12, 18 months getting cozied up to Apple and all these mega cap stuff, whatever I don't know if it was the new safety trade or whatever we want to call it, but we spent a lot of time last year talking about these types of stocks. And we've had, the Magnificent 7 ETFs have all debuted coming into 2024, of course.
All sorts of them.
So now we have tons of easy access down in your face. I think Amazon's okay.
Yeah, correct. From a Magnificent 7 standpoint, the outliers are really your Tesla and Apple.
Yes.
And Apple was the chief. Apple was the general. Apple was the star of the stars. And it's being rotated out of. It's negative on the year.
Microsoft's in line with the S&P since Halloween when the rally started. So it hasn't done anything extra.
Right. That would be star number 2, right? If you're going to have a team full of stars, that's 1A, 1B. And Microsoft is held up even. Apple is negative year to date.
So what's the mantra? So we clearly can't play the 7, 10 stocks are holding up the broad indices this year.
No, I think it goes back to what you were saying. Mid caps have held and done well, and the momentum factor has done well. Momentum has returned to this market.
Momentum funds have been very strong. In 2020, I mean, I see it across multiple funds. 2023, the more concentrated you were, the harder it was to find traction,
Yeah.
Under 50 names, under 40 names, which not a lot of funds do. We do. Hard to find traction, but a much better Q1 2024 from a majority of those type of strategies.
And those had been out of favor for a while. Momentum had been out of the market for a while. Now, there's multiple ways to define momentum. What I'm speaking to is just the ETFs that are using momentum characteristics, and they're all different, right? Some rebalance quarterly, some rebalance semi-annually. So you lose some of that momentum. So it's not a pure momentum play. It's just interesting to note, though, that momentum has returned from a factor standpoint. We're seeing mid caps and small caps do well while Apple is weak. Many people would have anticipated that if Apple's weak, the market is weak. Well, we haven't seen that because we're seeing a rotation, right? And rotation is the lifeblood of markets. And I think this would be a good time to highlight the supporter of this podcast, Adaptive Select ETF ADPV, which is a momentum product, which helps investors access two of the most prevalent factors in markets, which are momentum and relative strength. Using proprietary identification methods, Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. Ian, thanks for letting me put that brief commercial in there, but it is worth noting that momentum is back in this market. It's not dictated by 7 stocks. You're really seeing a broadening out when we talk about mid cap and small cap holding up since the breath rush in mid-December. And I go back to that time frame when we were communicating to our listeners that the table was set. When we had that capitulation event in late October, early November, where we saw these breadth thrusts, the table was set for the market to move higher. We've seen that. I would make the argument that last week and this week is the table setting for small caps and mid caps to lead from this point forward. Does it happen? We don't know.
So mid caps, MDY. I mean, they're already at all-time highs, and they are already above their relative 200-day. So they get the first ticket to cross the bridge. With small caps, right? So if we'll get to this later, like if it's going to happen, you would see, I think, the beta from small caps eventually in the intermediate term, short to intermediate term, overpower mid caps. Similar to, like, I think what you would like to see in like gold miners versus gold. You'd like to see the higher beta thing, kind of. You can be involved in both, but I think it adds to the bull case.
Yeah,
I think it adds to the bull case.
Yes.
If small caps outperform mid caps.
Yes, I would agree with that. If mid
doesn't mean they can't both outperform the S&P and mid caps do better and breadth is fine. We can slice this up in a million different ways. I'm just saying it's an added tailwind. It would be great to see mid caps, on a relative relationship chart, overtake mid caps this spring and into the summer.
Yeah, absolutely. And for those who might be new as a listener or a new client, the way to envision this, and forgive me for using a food analogy, but when you think about a loaf of bread, slice it traditionally, or you could be crazy and slice it horizontally, and your large caps would be at the top of the loaf, your mid caps would be mid loaf, and then your small caps would be the lower part of the loaf. All of them can be delicious if they're in an uptrend. The point being that Ian's saying is that you could have a scenario where mid caps are outperforming, but small caps are outperforming more than mid caps. And that's a really bullish environment.
Yeah, it's going to be a real weird change of pace if over the next 3, 6, 9 months, everyone turns on CNBC and they see S&P is flat, NASDAQ is flat or down. Like the long-forgotten Russell, the long-forgotten mid-cap 400, if these names are kind of just over here trucking away while the financial media whines about their magnificent seven.
Those are the large cap. They've been the darlings of 2023. They were the darlings coming out of the COVID correction. But now you're seeing this, what could be a rotation into mid caps and small caps. And there's nothing wrong with seeing those areas that are under recognized perform well.
I mean, for years.
Yeah, right. For years. And
we're going on since GFC, right?
Right. Great financial crisis. Yep.
Mid caps did outperform, and I guess IWM versus S&P technically peaked 2014. So we're going on March. It peaked March 2014. Doesn't bottom March 2024. I don't know, but that's a decade. That is a decade of underperforming. There's things that move in and out of, demand every day in the market. Short term, intermediate term, long term. 10 years for considering a major index, one of the major four.
For sure.
To underperform for a decade and that's a tough go.
And that goes back to like time frame matters, right? So there's a whole part of the industry that talks about small value in the long run. Let's simplify it. Let's just use technical analysis. Let's use some ratio analysis. Let's take the small caps versus the S&P. Let's use that analysis to identify where is the low risk entry, where is the spot where we could see one start to outpace the other, rather than overcomplicating it and saying, oh, it's over 30 years, it's small value. Well,
if you're 65, I ain't got 30 years.
Right. Like there's a decade.
I'm retiring now. I got my Social Security and I got XYZ of what I've saved up. I'm not waiting for your French Fama small cap value theory to come around.
Correct.
It probably will. I don't know. I mean, it will. Like, I get it. I get the data. I get it.
Well, and it's
If
looking at
you've
it.
got 30 to 50 years.
Yeah, it's looking at it as a table rather than a chart.
Or what's in your best interest for your time frame.
Correct. And
if
right
you're 20,
now,
yeah, let's do it. If you're 70, maybe not.
And right now, what's interesting is small cap and even small cap value related to large cap is at a low risk entry point. If you're going to see small caps outperform, or if you're going to see value outperform, this is the spot, right? This is the spot.
Even a reversion to the mean on like a long-term weekly chart, I could argue, let's say over the next 5-10 years, small caps continue to underperform. Very likely, but even some type of revision to the mean. So a revision in a downtrend, like a snapback we had 2015, 2016, obviously post-COVID, small caps severely outperform. If we get something else like that, I mean, you're still looking at 18% of alpha. Yeah. And let's say that occurs over the next 6 months. Like, I mean, I'll take it. And again, this tells us, right, when we talk about relationships, I always like to preface. And in fact, I had this conversation with new clients last night. Relationships don't tell us whether something's going up or down. They tell us where was the best spot to have your money during that time. Just which one did better. A relationship chart can look great, but if one goes down 8 and one goes down 4, it looked like one was better to be in. Well, we still don't really want to be involved in either. Right. So I always want to keep that in mind as well. Do they both underperform? Or is S&P down, but Russell's flat for the summer? I don't know. We're just talking about alpha and performance here.
Correct. We don't know. The fact remains S&P 500 is an uptrend. IWM is now entering a new uptrend that we haven't seen since March of 2022. So plenty of room to run on a relative basis using small caps versus S&P. This goes back to that risk reward analysis, right? So you could take an entry into small caps here on a relative basis. You have 2% risk. There's a risk that you enter small caps and you're wrong and you lose 2% on a relative basis, the opportunity cost. I'm not saying an absolute basis. I'm just saying you could have been in the S&P. You weren't because you're in small caps. Now, the flip side is that Ian's talking about this reversion to the mean. We have about 19% upside. So 2% risk for 19% upside. That's what's called an 8-to-1 reward to risk ratio. You take that trade, it's kind of like that 2-1 fastball. Like you're going to hack, like you're going to take that swing because that's the environment you're in. Is you've got the fat pitch. This is the fat pitch. And here we're in this environment where on an absolute basis, small caps are clearing an important level. On a relative basis, they're against a horizontal level that reduces opportunity cost. This is the fat pitch. Does it take place? I have no idea. We could hack and swing and miss, and that's okay. That still means it was the appropriate approach to swing at the 2-1 pitch, at the 2-0 pitch, because it's coming down the middle of the plate.
Dave's really feeling some opening day energy here.
Yeah, yes, I am. I'm a little fired up. I don't know why.
You guys got delayed. We got delayed for weather.
Oh, you guys got delayed too?
Yeah.
Oh, really?
Yeah.
Is Atlanta at home?
They are.
Because Brewers got delayed because they were up in the Northeast for the Yankees. And so we got delayed there. And it's mind blowing because, right, Brewers have a roof. And so we could be playing on opening day.
It's in Philly. It's in Philly. We were to open in Philly.
So there you go.
We were opening against Phillies in Atlanta.
So it's kind of like, hey, and I should clarify, it wasn't the Yankees, it was the Mets.
Yeah, Mets.
For the Brewers. For Atlanta, it was the Phillies. Maybe we just don't do baseball in the north side. Like, let's not do baseball north of Kentucky unless you've got a roof. I think that would be a good way to do opening day. That would be the way I would do it.
Yeah, we'll so just convince all the taxpayers.
Man, you guys are delayed too. That's crazy. Huh.
Yeah.
Anywho, if we're going to take that fat pitch on small caps as a potential place to gain alpha versus S&P 500, this is a logical level. It's not a recommendation. Let's be adults here. Like people who are listening to this is not a recommendation. This is just market analysis using technical analysis, which is the study of supply and demand.
And I think the case improves if we get above that 210 level we mentioned.
Mm-hmm.
And we could. I mean, we had yesterday, Frank Capillari. I want to make sure I get this statistic right, but Frank Capillari, great technician. He said yesterday, so best day of and I think the market was kind of flat. Yes. Was the market kind of flat? Yes. Or no, we had kind of rallied at the end. But anyways, best day of S&P internals, 90% up day yesterday on the S&P. This is the best day of the year internally for S&P yesterday.
Nice.
As large cap tech basically held down all of the beauty that was going on underneath. And so it's kind of that argument, like it was fun on the way. Like it's going to be painful if these are the names that underperform while we have these random names that everyone's forgot about. All the names that had their 70, 80% drawdowns in 2021, 2022, your software names, right? Your apps, all these, right? They're breaking out of bases. Robinhood, we can go through, do a basic scan for 1 month highs and look at all the names, your ARC-ish type names coming out of major bases. Look at ARC itself consolidating here. Really, look at ARC.
ARC-F, ARC-W, ARC-K.
We've talked about on the team this year. So I think ARC on an absolute basis, holy cow, look at that consolidate. It's flat since December 15th. So think about that. These names have pent up energy for over 3 months. And I'm sorry, but that if I'm a technician, I look at the ARC chart and I get excited. That would be such a big tailwind. And those are the types of names I'm talking about.
And what Ian's talking about is ARKK, which is a risk on barometer, right? It's taking technology, but going 1 degree, 3 degrees to the extreme to the right of risk taking for tech. And here we have something that's been compressing for 2 to 3 months. That 2 to 3 months is also doing this compressing alongside a 2-year base. So like this base that's been building for 2 years and something like ARKK. And then if we take this to another level and we compare something to like ICVT, so Indigo, Charlie, Victor.
Okay. I see where you're going to go with this.
Yeah. So Indigo, Charlie, Victor, Tango, ICVT versus aggregate bonds as a whole. So ICVT representing the credit instruments of something like ARC, meaning your higher risk convertible bonds outperforming AGG. That is further confirmation that there's risk taking going on.
Let's talk about these. MicroStrategy, Wayfair, Uber. This is mid cap, higher beta. We got to get new cap weightings for categories. That's a different conversation for a different episode because we just can't, small caps cannot be 300 million to 2 billion anymore.
Right.
We got to bump some things up. I will say this is not AAA core convertible debt.
No, it's Uber, MongoDB, Seagate.
Dexcom.
You got some Carnival, Airbnb, Booking.com, Coinbase, Zscaler. Like these are the credit instruments for some pretty high beta, high risk companies.
Spotify, Rivian.
And so
here you have airlines in here. I think Jets had a pretty good week, speaking of airlines.
And so you have convertible bonds for some of the most high-tech, quote-unquote, high-risk areas, outperforming aggregate bonds. And that is indicative of a risk-on environment.
Okay, so that's the bond market. If you've been here for 4.5 years, you know our feelings on fixed income market. Arguably, probably more smarter than the equity market. So if they're buying the debt, if they have faith in these companies that they're willing to buy their debt, then they probably have faith that the companies are going to survive, right? They're going to be okay. And that bodes well for the underlying equities as far as attitude and, how do investors view this? Obviously, we can look at an equity price chart. But to your point, looking at the debt instruments, and Dave and I are not on Bloomberg terminal every day looking at the debt issuances of stocks we own or stocks in the ETF. At a great 30,000 foot view, this is an awesome way to view How does the fixed income feel about these ARC-ish type names?
Look like they feel pretty good. Same, you could use junk
Datadog,
versus
Snap, HubSpot, SoFi. Yeah, this is not Coca-Cola and United Healthcare.
so there's risk taking going on in the credit markets, which in our analysis, credit markets tend to be more thorough, deep diving your equity markets.
One
And
Kevin brought up yesterday.
I do want to highlight Kevin because Kevin does great work. But speaking of credit markets, supporting that is something like IPO, right? An ETF that represents initial public offerings. IPO has that similar look to your ARC funds, that risk taking, that we're going to take on risk in this environment. But go ahead with what we were going to say about what Kevin highlighted.
He's on fixed income this month. He just highlighted the ICVT, right? Because everything, just stocks to us, same thing in fixed income. You got to be better in a benchmark.
Right.
ICVT versus AGG. I mean, you want to talk about bases and 2-year highs in relationship. I mean, you could overlay this with the Russell 2000 almost. Now I'm looking at it both unadjusted and adjusted for dividends, but yeah, it's risk on. And you see, so let's stay in fixed income, high yield spreads made. I haven't looked at them in like 2 days, but I know last week they were making new lows.
Well, they continue to be in a downtrend since October of 2022, which is where we bottomed. It's where equities bottom was in October of 2022. We continue to see credit spreads, triple C credit spreads, your crap of credit, continue to cool off. Like it's a liquidity barometer. We continue to see that, and that's not even touching base on, like, we talk about U.S. small caps, but even European small caps are on the verge of making highs they haven't seen since 2022. Like, how bad are things if we're buying European small caps? How bad are things if we're buying tech credit versus the broad credit market?
I got something for you. You want to hear how bad are things, David, if your best over the last 2 months, what's the best area in the world? 2 months.
2 months, what's the best area of the world?
In the world.
2 months. European financials? No.
Frontier markets.
Frontier markets?
Frontier markets up 9% over the last 2 months. S&P's up 6%.
Yeah, that's...
And people want to tell me there's not risk-taking still going on.
Well, even look at frontier markets using FM versus FM, Frank Mary, versus S&P. That is a base that goes back to June of 2022.
I'm just saying. Yeah, look at that.
That is risk-taking behavior. Wow. We haven't talked about frontier markets in a while.
We've never talked about frontier markets in a positive way on this podcast. Probably. I mean, they had a nice run in, obviously, post-COVID.
Yeah, so
they look like your typical ARC name just coming out, and your typical small cap name, your typical average stock coming out of a 2-year base.
Yes, so I think that's a fair way to say it. There's so many stocks that are coming out of a 2-year base that, and for some, it is not fathomable to think about the move we've had in the broad market, U.S. speaking, S&P speaking, since late October of 23, right? So we're on the verge of November, December, January, February, March, right? 5 months of a really, historically quality move. And it seems asinine that we could be sitting on this episode 200, talking about it's just getting started because of what we're seeing happening underneath the surface with the characteristics of something like frontier markets, something like small caps, something like micro caps, something like value, something like high beta versus low vol, something like ICVT versus AGG. All these things are pointing towards the rest of this year being extremely strong. It doesn't have to be this way. Like, we could fail at 210 on IWM, could see frontier markets, back below $28. We're not here saying that's what 24 is going to be. We're here saying the table is set once again.
We're a quarter in, man. We are a quarter in. It is a low vol. I mean, we haven't had a 5%. We haven't had a 5% correction, have we?
No, I don't even know if we've had 2.
I was gonna say I don't know if we've had.
I don't think we've had 2%.
to start the year, we had and these all last the next 1.6 late Jan. I mean, it's shaping up to be. I don't want to say it. I don't want to jinx it. Do we got VIX at 13. VIX has been between 13 and 15 all year. That's a low volatility environment historically, right? Yeah, it has its moves from 13 to 15 and people get all excited and blah, blah, blah. But historically, this is what you see in these grinding environments.
Okay, so in an election year with an incumbent, we typically see a weak first half of March, right, into the Ides of March, into the 15th of March. We didn't get that. And that's where you need, as a technician, as a market historian, you have to understand when that takes place. Wait a minute, that's different. The fact that you have a market that didn't obey or didn't have a match the tendency of March, we just blew right through it. How much more bullish is it then? So again, the pieces continue to align, a much more bullish outcome for 2024 than many are expecting. And this goes back to the original thesis. This market is not allowing people in.
No, it is not. You've brought that up a few times this year. You've brought it up on here. You've brought it up on our market calls. 100% absolutely agree with that sentiment. This is a market where, back to a few minutes ago, every 2 to 3% correction continues to get bought up. We've talked about it before. Is it right? We talked about in 2022, 2023, $8.5 trillion or whatever it was in cash and money markets. Some point that probably will come off the table, right? Because the market hasn't gone down. We know how clients are if you're just sitting there. Get me my 5%. Well, now we're on a 5-month rally with the S&P and whatever it's up a lot. And 5%, as risk-free as it is, doesn't sound so sexy anymore.
No. Peak T-bill was a long time ago. Going back to the fiduciary standard of best interest, that's why we're an emotional bodyguard for our clients, is that...
And CDs, remember all that?
Yep.
CDs.
While 5% sounds nice, I can tell you that 20% sounds better.
And now you've got your CD locked up for 12, 24 months while stocks rip.
So the pieces continue to align. Again, we could have a corrective April. I'm not here to tell the market what to do, but this goes back to understanding the characteristics, the market environment as a whole, when it is shirking its seasonal tendencies, when it's not. And really, since the beginning of January, we have seen broadening out. Yet
we've shirked them, dude. We've shirked them.
You shirked them. Like, we did not have the March weakness. We did not have the late February weakness. And so you sit up and say, okay, that's interesting. You have frontier markets, which you highlighted, breaking out to a high it hasn't seen in over 2 years. You have all these high risk tech areas, right? These are companies that are taking on tremendous risk to carry out their business, meaning they're taking on debt, they're not profitable, and you have investors, institutions putting money to work there, coming out at 2 and 3 year bases. 2 to 3 years is not a small feat as far as the base goes.
How frustrating. Okay, check out regional banks, IAT.
Okay. Yeah. Like, yes.
It's going to be a frustrating stretch because I can tell you, I don't think many people in America are over allocated to regional banks after the last. We obviously had our little crisis last year.
We'll look at XLF as a whole. Brand new staking, closing highs. And I'm not saying it's outperforming. I'm not saying that there's not opportunity cost there.
It's trying.
But it is, anytime you've got a bellwether like JP Morgan continuing to record new all-time highs, how bearish can you be? Like, when you look at the financial sector, and this is very similar to talking about the staples, right? You're very good at highlighting, Ian, that staples, it's a matter directionally of where they're headed, right? If they are headed downwards in a downtrend and outperforming the S&P, that's a really risk-off scenario. Financials can be heading upwards on an absolute basis, underperforming on a relative basis, but it's still a really positive characteristic to see financials doing well. And here you have financials as a whole making new all-time highs. You have the bellwethers like JP Morgan continue to make new all-time highs. I don't know
And
what to
that's
tell them.
crazy, right? And you look at financials on an absolute basis, which has been in a great trend. I mean, no one looks at XLF and says, oh, that's been a week. But are you kidding me? I mean, yeah. So XLF just now breaking out, and it's so off the Halloween lows, up 35%. And so you're telling me now it's going to start outperforming? And that is a totally non-0% chance that happens.
I think it's a great way to put it. Non-0% chance. And when you look at regional banks, or let's just look at XLF versus IWM, right? That's a massive base. If it starts to lead, if you're taking XLF versus IWM, that base, that price range, that's going back to the depths of the financial crisis. Like we're breaking above levels we haven't seen since August of 2009. We're on the verge of doing that using XLF versus IWM. Like some of these things could just be getting started.
Those that are already frustrated, those that like to tie the economy to the stock market, at least over the short and intermediate term, crazy to think it could actually get that much more frustrating for that type of mindset, those types of investors out there.
Well, and there's other pieces out there, when we talk about economically sensitive, like you look at like retail using something like XRT, clearing out of a base. You look at housing using something like XHB on a relative basis, continues versus S&P to confirm a base breakout that goes back to 2007. You have transportation, which I know has lagged, right? There is a Dow theory here. We're on the verge of holding these all-time highs that are recorded last week using something like IYT. And then you're seeing the conductors of data, semiconductors.
But transport's combined. I mean, transport's on a relative basis. It's so crazy just now. The average stock has had a good year so far.
Right.
And we're just now, like, if someone said I want to get overweight transports today, and I'm going to use this as my my absolute and relative levels. I mean, I'm not telling them they're crazy.
And so there's a lot of pieces that are lining up internationally. Broadly speaking, if you take something like VU or VT and compare it to S&P, it's still underperforming. There are pockets, right? Japan continues to be a surprise. I'm going to say a surprise. I hate using that term anyway, but like it continues to be a place of strength. Argentina, you see the sentiment shift, but it continues to be a U.S. story. It continues to be now arguably, from a risk reward standpoint, a small cap story. And that's why we use technical analysis is where is the opportunity cost? And if small caps lead from this point forward for the next 5 years to a decade, I'm not saying that's what's happening, but if it does, we do have ratio charts to understand when that's happening. And the table is set for that to start happening at this point. Doesn't have to do it. That's the beauty of thinking in thesis rather than marrying your opinion, rather than marrying your ego. You get to develop thesis and say, if we're above this level, that thesis is intact. And when you look at small caps versus S&P 500, we're definitely at a level from a risk reward standpoint where the table is set for small caps outperform. Does it happen? I wish I could tell you, but this is what it looks like. If it happens, and 6 months later, 6 months from now, we're saying, wow, look at what small caps did, both on an absolute and relative basis. You don't get to be surprised if you're a technician. Let's be diligent in our process and identify these areas of risk and reward. And here we have one of those scenarios. And you even brought up a really interesting, at the beginning of this episode, 200th episode, you brought up gold miners.
Gold miners.
That is something we haven't talked about for a while. We have gold itself, the actual physical metal, the futures making new highs. Like that is matching the small cap environment, right? Because there's a lot of small cap, there's a lot of junior gold miners. And I think we would argue, Ian, correct me if I'm wrong, mining overall Like, not
Mining
just gold miners.
overall, obviously, we're going to talk about gold. We got to talk about silver.
Yes.
But the base metals, I think steel, I guess you don't mine steel, you mine ore, but steel stocks look great.
That's a good point.
Steel stocks look really good. And that's another thing you got to get outside the S&P to find those.
Good point.
That's I highly doubt steel stocks are on anyone's radar if you are following mainstream financial media. I could be wrong. Maybe they had a big segment on CNBC today about steel stocks.
They're on the verge of breaking out of a base. They haven't yet, but on the verge of a base that goes back to 2011. 2011. Same thing with copper. Like, you look at copper miners like CopX, and you compare that to something like the S&P 500. It is the stage 2 range that it's building out of a base that goes back to 2014. So you have some of these raw material things setting up, which matches that value trade, which matches small. The thesis continues to build. And meanwhile, it's not like tech has given up. It's not like it's over for tech. You highlighted ARC K already, ARC W. Like, there are technology pieces that are on the more risk end of the spectrum than something like Apple. No, we wouldn't have had something on our bingo card for 2024 of Apple selling off and the S&P 500 being fine. But if there was a way to do it, this would be it. It would be your small cap tech, your small cap value carrying the market, being rotated into while Apple's weak. There's nothing wrong with this. What else are we missing? I know we haven't touched base on crypto yet.
Crypto, I mean, hanging out, doing, right? And so, well, we talked about gold. Here's your argument. Is your time and money and capital better well spent in crypto? And Bitcoin versus gold, I mean, that's a pretty fair argument. But yeah, Bitcoin, continues to consolidate up here above those highs from 2021, April and November 2021. So around 70,000. We retested 60 just 8 days ago. And so short-term demand showed up where it needed to. So the uptrend remains intact. If we consolidate here, great. Can't tell you how long we would consolidate, but that would be pretty healthy on your way to, I mean, I don't know what the measured move there is, Dave, but it has got to be pretty big coming out of this base.
It's about 250%. So we're talking about 233,000 for something like Bitcoin.
So first Fibonacci
extension
is going to take you to 101. We'll call it 100. It's your 1.618. But yeah, it continues to do what it needs to do. And did talk about this in a previous episode. So far, it does not seem like release of the Bitcoin ETFs have been a top caller.
Not at all.
Which was also true when GLD came out.
Yeah, correct. When GLD came out, that
gold
was not
did rip. Yeah.
It ripped. And we're on the verge of closing at a new weekly closing high. We got a couple days to wait for BTC USD. But if we are closing above 69,000, right, we're on the verge of a new high. And again, another instrument that could now start to record a cluster of new highs. And so here you have this environment where we're seeing risk on in credit, risk on in small, risk on in crypto. You have gold making new highs. And we haven't even talked about oil yet.
Oil and energy.
Or energy, yeah. Like, there's so many pieces.
Man. You are saying 2014, right?
Yep. I mean, that's
a new for highest close. That's wild. September 2014. And that's a beautiful base. I mean, it's crazy. Again, we said this earlier, but it's crazy to sit here after the rally we've had and say, yeah, but look at all these other stocks with pent up, no pun intended, energy.
The table is set. Once again, we talked about the table being set in early November of 2023. You can go back and listen to that episode or multiple episodes.
Yeah.
We're now at episode 200, and the table is set yet once again, and it looks like the leadership might be elsewhere. And that's okay. Like, it's great when your bench plays well. It's great when Bobby Portis is the sixth man. Like, these are things you want to see. You want to see your team perform well when a starter goes down, like Apple. And if that's what we're on the verge of, so be it. And let's not fight the tape. You know, I know everybody wants to focus on rate forecasts and blah, 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 all the things that get revised later. Let's
You
just
know what we
focus
don't
on
talk
price.
about anymore?
What's that?
Dot plots.
Dot plots. That's yeah.
Remember
you're right.
those?
Yeah, I remember those.
Yeah.
Do they even use those anymore? I'm not
I
even
don't
sure.
know.
Don't know, don't care.
If they ever start using it again, I'm sure Twitter will let me know.
Exactly. We're wrapping up the end of our time. Ian, I always love doing these with you. Sorry that
200 of them, man.
Yeah, 200 of it. I mean,
A lot of that's
that's a lot.
200. That's roughly 200 hours. I guess they haven't all been an hour, but we'll
Lot of
ballpark
work.
it there.
Yeah, and so special thanks to the Client First team who has believed in this and supported it. You know, Kevin and Dan, they're not necessarily on these episodes a lot, but there's been interns that have been involved, those who do that. You know, we edit podcasts. There are so many people that touch this, resources that go into it. And so if you're listening to this and you like it, and you're like, man, I want you to do 200 more episodes, the best thing you can do is share this with other people and give us high rankings so that other people can hear about it. That's one of the best things that you can do for us as a company.
I mean, we do this, I would say it's about as late as we can on a Friday and still do our day jobs, right? We're big on closing prices. It's daily and weekly, and we get it out Monday or Saturday morning. So it's a quick, I'd say 18-hour turnaround time. And there's a lot of effort that goes into it.
Amen. And we have more March Madness upon us, Ian. I'm sorry that the Gamecocks are out. We're going to get to our Final Four. It's going to be wonderful. Same with this weekend being Easter weekend, right? This is the Super Bowl for those who believe they need a savior. We got Monday, Thursday, right? The commandment, the mandate. Hey, love others as I have loved you. And the way Jesus loved us is he sacrificed everything, including life, to make sure that we get heaven. And that's Easter Sunday when we celebrate the resurrection. Just an amazing weekend. We got basketball. We got Jesus, the ultimate champion, the ultimate NCAA champion, carrying us forward, giving us the jersey of righteousness. And so with that, I want to end, Ian, but thank you very much for your time and everybody listening. We really appreciate it.
Have a great weekend, everyone.